Welcome to our spring Join the Conversation session. We've been doing these for, I think, going on 3 years now on a variety of topics. I'm Michelle Hipskin. I'm a certified financial planner working with SYM Financial Advisors, and I have a personal passion for educating women in financial services. And I'm joined today by a very special guest, Ashley Ilardo. She is from Dimensional Fund Advisors. I'll let her tell you a bit about herself, but first want to tell you that we're really thrilled she's here today because she works for a mutual fund company with more than $6 billion under management altogether. But more importantly, I think, is she's a director in their women's programming. So I've been familiar with Ashley and the program at Dimensional for several years now and have attended their events. And they have a particular, not only passion, but affinity for working with all of us women. So Ashley, tell us a little bit about you.
Yes, of course. And hi, everyone. It's so great to be with you today. I'm so excited that I wasn't invited to the watch party, actually. I'm so jealous I wasn't invited to the watch party. But great to be with you. So as Michelle said, I'm Ashley. I'm a regional director at Dimensional Fund Advisors. I've worn many different hats throughout the business over my 5-year career at Dimensional. But most recently, I co-chair the Women in Wealth Steering Committee and the Women in Wealth Community. And really the goal there is to bring advisors together to talk about, is serving women different? If so, how? And what can Dimensional do to support advisors who are trying to serve women? So fast forward to today, we're a community of over 700 advisors strong, Michelle and many other SYM advisors being involved. And it's so great to be with you today just to talk about some of the common financial hurdles that women may go through and also share some investment principles as well. That way we can navigate those hurdles and make sure that we're meeting all of the financial goals that we have throughout our lives.
Okay, great. And as I mentioned, I've got Jamie Mitchell here with me monitoring the chat. So please feel free. Ashley and I are both very conversational and kind of off the cuff in our approach. So please just chime right in if you have questions or even just comments. That's kind of the whole point. Our Join the Conversation theme is truly meant to be comfortable and conversational. Over time, our industry really hasn't done a good job, at least historically, of serving the needs of women and speaking our language. So that's a real goal for us in this programming. In fact, this fall, we plan to get back to our in-person meetings and look forward to that. So we'll have in-person gatherings as we have in the past and continue to live stream as well. We've gotten feedback that is helpful for people, especially that are out of town or further away. So without further ado, we'll launch into investing post-pandemic. And you'll have to forgive me, I have to screen share for just a second here. Technology is my friend today. So hopefully everybody can see our slide. We good? Okay, Jamie says we're good. So we're good to go. So here we are. We've got Ashley and myself, and we will start off by looking back. So the whole theme here is this post-pandemic, because fortunately we're almost post-pandemic. But if we go back just a year ago, things were much different. And that kind of gives us perspective on the whole conversation that Ashley and I are going to lead. So if you think back to February, March of last year, we were seeing headlines like this one on a regular basis. You couldn't get away from the markets are falling, the world is closing, the economies are suffering, all of those things. In fact, on March 23rd was the actual day last year, the S&P was down 34%. And you can only imagine the responses to that as investors started to panic. The Dow pulled back, the NASDAQ pulled back. We were in bear market territory. So there was a lot of emotion going on and so much uncertainty. It was really uncomfortable. At that point, we didn't know what coronavirus really was, how to treat it, how long it was going to last. And there was just confusion. In fact, that March, that week before the state of Indiana shut down, we were having a Join the Conversation session. in person, and the caterer said, I might have to leave and not be able to serve you. We're waiting for the governor to make a declaration about what's going on in the state. So, everything was up in the air. And people started to realize that beyond being quarantined, their account balances were suffering. Their 401k values were changing. Maybe they couldn't retire when they wanted to retire. They'd have to work for 2 more years. So it was chaos, and it was very uncomfortable. Ashley, why don't you you and I have talked about this a little bit. Why don't you tell us what some of the questions and concerns you were fielding from advisors? More importantly, what you were fielding at your own dinner table when you went home from your job and still had to talk about it?
Yeah, of course. I mean, around the office, first and foremost, we were getting the questions, will the stock market crash? Everybody is seeing these headlines and saying, do I need to pull out my money? Do I need to put it in cash? What should I invest in? When's the right time to pull out, go back in? And also we were getting a lot of questions around how we were doing. It's great being in this industry that we have such a close relationships with many of the advisors that we work with. But definitely those questions were coming in. A lot of investors were asking those questions. Even within my own dinner table, the conversations were very interesting. My husband and I definitely have differing views sometimes around what we should do with our personal finances. But first and foremost, of course, we were asking the question, how do we keep our family safe? At the time, my brother was living with us as well. So how do we keep him safe? How do we keep myself safe? I do have a pre-existing condition. So that was something that we were navigating on top of, should we move forward with our new build? We actually signed a contract in February to build a new house right before everything hit. And we got really nervous around where everything was going to go. My husband was asking, should we pause on investing more in the market? Is now not the time to do that? Should I change my retirement allocation? He was checking his statements on a daily basis. So overall, even just within my own household, we were getting so many different questions around, what do we need to do? What is the response that needs to happen because of everything going on?
Did you feel like you couldn't get away from it?
Absolutely. I felt like I couldn't get away from it. It was something that, after I'd leave work, I'd come home, then my husband would ask the same exact questions that I was getting at work. And I'm happy that at least we were able to engage in that conversation, have that time to reflect on, well, let's think about our family's goals, what we want to achieve, the fact that we do want to retire at some point, that we want to make sure we're protecting against things like inflation over the long term. So we need to stay disciplined. We need to stay buckled down. And we were able at least to work through that within our own household. It was good practice as well for those conversations with advisors too.
Right. And actually, not only for Ashley and myself, not being able to get away from the headlines and the messages and the chaos, but for all of us on this call and everybody, it's on social media, it was on the radio, on the television, the market's this, the market's that, you really can't escape it. So that's part of what we want to talk about a little bit today is how to handle that. So let's fast forward now 13 months. So these are recent clips that I just took in the last week or so off of CNBC and other websites. We have done a complete 180, more so even than where we were just over a year ago. All-time highs. We're recovering. The economy is expanding. Now we're expecting inflation. I mean, the headlines now are so different. And in contrast, it's almost like whiplash. In fact, last February, we were at an all-time high. March 23rd, we fell 34%. It was the fastest fall into bear territory ever, even faster than the 1929 crash of the stock market. So it was really fast and very significant. Likewise, our recovery has been one of 3 fastest to ever occur, from the low point back up to full recovery. So it's really been a quick, fascinating turn of events, if you will, and we're in a much different place today. Instead of people saying, do I have to work longer or should I change my asset allocation? Now our questions are becoming, the market's going to pull back again. I'm just not comfortable. I have some extra cash. I'm afraid to get into the market. What about inflation? So the questions have changed completely. So Ashley, you get a lot of these questions at Dimensional. Can you tell us a little bit about what you hear and more importantly, what your messaging looks like?
Yeah, the number one message I think that we're really thinking about right now is stay the course and control what you can control. There's so many stories of people getting out of the market either after it drops a lot, after it's reached a new all-time high, just for it to surpass in the future and really missing out on those returns. And I think these concepts are particularly important for women as well. If we think about some of those unique financial hurdles that many women go through, we typically need more through retirement. We typically outlive men by 5 years. Many of us in a traditionally married couple outlive our spouses by 14 years. And if you think about things such as higher healthcare costs innately because we live longer and often don't have caretakers as we age, as well as some of the financial hurdles that we face throughout our lifetimes as we're growing our wealth, such as lower potential lifetime earnings or greater financial setbacks due to divorce, it's really important for us to stay the course, stay invested over the long term, and really focus on the things that you can control. Focus on things such as your asset allocation, things that you can do to dial up and down your exposure, something, of course, that Michelle can help you with to make sure that you're balancing that future along with what you can handle today.
Great, thank you. So we talked about last year, we talked about this year, the whiplash, the speed with which everything is changing, especially the messaging that we can't avoid. And here we have a graph, and there are multiple versions of this, but this picture shows the roller coaster that we went through in the last 13 months, that we've gone through in the past. One of the big takeaways for me on this flow of optimism up to elation, then we get a little nervous, then we have fear, and then we cycle back into optimism again. But that's an individual feeling. We typically see investors cycle through that, but the catch is the market cycles through that too, in part because as investors take action on their emotions, which is a whole different ballgame. As investors take action, then that compounds and the market reacts. And then when the market reacts, falls, for example, then the investors get more fearful and sell more, and the market reacts more. And you get this flywheel effect. And you can see how quickly things would change, especially with all of our electronic trading availability now. So we all know in our brains that we want to buy low and sell high. So let's look at the line on this chart and see from an emotional perspective if that really works. So if we look here and think about last year, we were coming into 2020 riding a wave of elation. The market was at all-time highs. The economy was at historic levels, a period of growth longer than we had ever seen. So in February, early February, we're all thinking we're on top of the world. Everything's great. And well, yeah, there's some people sick on a cruise ship. The catch is, long about mid to late February, we started getting nervous about what is this virus? What's it going to mean to us? Is the US even going to be affected? So we start to feel a little uncomfortable. The messaging starts in. We start to see the markets respond a little bit. Then we fall down here, March 23rd, for example, that 34% pullback. That's when we're in fear. That's when Ashley's folks and the folks of us here at SYM and all other advisors were getting phone calls from people saying, oh my gosh, what do we do? That messaging, that constant soundtrack that we just can't get away from instills fear. And then fortunately, and potentially now, thanks to a vaccine and other things, we're coming back into an optimism phase. But what this emotional cycle causes us to do isn't buy low and sell high. In fact, if we react to our emotions, we typically would do just the opposite. So you're optimistic and you've got some money in the bank and wow, the market's doing great. I think I'll get in now. I feel really good about it. I want to get in and get some Amazon and some Apple. So you buy high because the market's great. Everybody's happy and confident. So you're buying high. Then we start to get nervous. Market responds, the market drops, and then we're scared. This is human nature, certainly not a criticism, but we get scared and we want to sell. So we already bought high and now we're going to sell low. And you can see as that cycles through years over years of time, how it can really be detrimental to an investment portfolio. One thing that I would say too, which has been really interesting this time, is we feel like we came back to optimism on November 6th, specifically. Even though there was a presidential election going on about that time, that's not the driver for us to look specifically at the return of optimism on November 6th. Rather, it was the promising news from the FDA that we were going to have a vaccine. We saw a light at the end of the tunnel. We didn't know how long it was going to take, but we knew it would get here at some point in 2021. Ashley, do you have anything you want to add into this?
Yeah, I would say this is something that even myself personally, I saw within my own household. When I saw the headlines of everything dropping, I approached my husband about actually increasing our allocation towards stocks. And I remember the conversations back and forth around, I don't think now's the time to do that. We have to focus on the house. We have to focus on what's going to happen in the future. And we don't know what's going to happen in the future. None of us knows what's going to happen in the future, but it's all about finding that balance within yourself as well and what works for you, and being able to control and follow your own emotions and really thinking about that asset allocation. Did convince him for us to put a little bit more money into the market. And I'm happy that we did now looking back. But it definitely was a scary time for us to think about what our allocation should be and if we should make any changes as well.
Great. You know, it's really easy to get out of the market when we're down here in fear. You figure, yeah, okay, well, I don't want to risk it getting worse than it is, so get me out now. And understandably so. But the hard part is getting back in. Yeah. Nobody can time the market. People get lucky, and there's a skill set in being good at choosing things, but without a crystal ball, there is no surefire way to time the market. And getting back in is the hardest part because you don't know when to do it. So to bring it home a little bit, we saw the fiscal crisis, 2008, 2009, and a lot of people did get out of the market. Things were down over 40% and they pulled out and they went to cash. And that was a long recession. That was a longer period of time, certainly, than what we're dealing with now. And there was a hesitancy to get back in because while the market was low, they were scared, didn't want to lose more by being in the market. And once the market started to recover and got back up to high levels, they felt better, but they didn't want to buy in then because it was expensive. So what we found was people that stayed in the equity markets and just looked away. They stayed in their seats. Looking back now, had a 10% per year average return in the S&P 500. People that didn't were less than half of that. Hindsight's 2020 and easier said than done, but certainly we have evidence that getting back in is really difficult to do.
Well, because then you have to make the decision of when is that perfect time, and no one's going to know when that perfect time is. So it's hard because you have to make so many decisions when you exit the market about getting back in, and then trying to time the market again. You have to decide when is everything high. Okay, now I have to get out. What individual securities am I going to buy if you're really going to play that game? And it's just a game that usually never wins.
It's a game. It's a gamble. I had a gentleman that I just couldn't convince to stay in the market last March, and he went to cash. And then after he felt better about things in the third quarter, he kind of put a toe back in the water and then finally fully invested now back in equity. So he sold low and he bought high against better advice, and it cost him about 40% return over the last 12 months. His return is about 1%. Had he stayed in, it would have been over 40. Okay, so let's take a look beyond our emotions now and look at the data. So this is quantitative. Let's look at the S&P 500, or I'm sorry, the global index. This is the all country world index. So think of it as a global version of the S&P 500. It goes back to 1970 and shows different points in time where significant events have happened that have affected the market. So those are called out with the lines and the blue labels, but the index, the global equity market, is that mountain chart or that black line that runs through the middle of everything. So Ashley, can you tell us a little bit about what's going on here and what the equity markets really do during crises?
Yeah, happy to. So thinking about different points of time, different crises that we all face, I think the phrase I always hear is this time is different. And this time is different in some aspects, especially in our personal lives, right? I personally have never been through a health pandemic before. So I was worried for my own personal health, for my family's health. I had a lot of family over in New York City. It was a very scary time in my life. But when thinking about the markets, there's a lot of different firsts that you see here on screen. And over time, even though that line isn't perfectly straight going up, over time, the markets have rewarded discipline. They have rewarded us staying in our seats, staying invested, navigating those times of volatility and turbulence so that we can continue to earn that higher expected return throughout our lives. You know, it's hard when the news and the financial commentary can really scare us, influence the way that we feel about investing. And when you have a strong investment philosophy that you can believe in to guide you, you're able to navigate all of the different events that you see here on screen, including the pandemic that we just faced, and really stay invested over the long time and make sure that we're able to meet all of our financial goals.
So to better see that in this chart, now this is 50 years worth of global market performance, but we've added just a straight line. This orange line here shows if you had stayed in your seat and were well diversified, this is where you would end up over time. So you would end up having gone from $1 to $80. 50 years is a long time, but that's certainly not a bad return to just stay the course. And think about it, the pandemic was certainly different this time. The reaction of the markets and the economy maybe wasn't different. And for those of us that remember these other events, think back to 9/11. That was certainly different. Think back to the Iraq War. That was, for a lot of us, the first active participation in a war type event. The dot-com bubble, Black Monday. I mean, we go back and back. In fact, we've had lots of global pandemics before. They just didn't hit the US quite as hard. So even though it was different, the responses were similar to what we've seen over long periods of time. Okay, so Ashley, you and I have mentioned a couple of times not only staying in the market or staying invested, but being properly diversified. And that's an easy term for you and I to toss around all day long. But what does it really mean to a lay person to be properly diversified?
Yes, there's many different aspects to diversification that you think of, and diversification may mean different things to different people, but really the fundamentals remain the same. So here on screen, if we compare a portfolio of all stocks, that's an investment of stocks within the US, stocks within the developed markets internationally, the emerging markets internationally. We have the ability to invest in many different global aspects. So that's one way that we're diversified, is where are the companies that we are holding? Even beyond that, if we think about just the US specifically, we can think about the number of securities that we hold within that market as well. Are we holding 1, 5, 10 names? Or are we actually holding that fully diversified portfolio that gives you exposure across the entire market, across small cap stocks, large cap stocks, value stocks, growth stocks. So diversification takes on many different forms and is really important, because if you don't focus on diversification, it can make weathering the storm a lot harder. You have to pick the right securities that are going to outperform. And how are you going to know what securities are going to outperform? You have to make decisions around when you're going to purchase these securities, when they hit that high, when you're going to sell those securities. And no one has been able to do that successfully. So when thinking about the things that are within your control, all of the aspects of diversification, whether it be the number of names that you hold within your own country, the number of names that you hold as you even expand your portfolio to a global allocation, it allows you to help weather that storm, not have to pick the stocks that are going to win, and overall, just a better investment experience. And what you see over time is that you're able to earn those rewards. What we've seen on that last chart, you're able to earn that almost straight line. Of course, you're going to have some ups and downs along the way, but overall, you're going to get rewarded over the long term.
And it occurs to me too, Ashley, to put you on the spot, the difference between picking a single stock versus the diversification that a mutual fund could offer. Can you explain the difference?
Yes. So thinking about an individual stock and trying to build our own asset allocation, choosing a few stocks, that can make you a lot of money. But as we said before, that's very unlikely. As we said before, we have to buy the right securities, buy it at the right time, sell it at the right time. You have to get multiple decisions right. But the more likely outcome is that you lose money. So when you exclude the top 10% of performers each year from your portfolio from 1994 on, your return was 3.6% compared to 7.9% from all stocks. So what a mutual fund allows you to do is to buy that larger group of securities so that you're able to earn the return of the market minus fees. And depending on how your position is allocated, if it's allocated towards small cap securities, value securities, you also have the ability to potentially have higher expected return over your lifetime as well. So it just allows you to have a broader exposure to many different parts of the market, and you don't have to play that game of figuring out, what am I going to buy? When am I going to buy it? You don't have to make those decisions. It allows you to sleep well at night and have a good investment experience over the long term.
Great. Thank you. So now we know, a well-diversified portfolio, proper asset allocation, but that still leaves a little bit of room for interpretation. So where do we go for a little help along the way, or some hints to make sure that we're doing it correctly? Trust but verify kind of a situation. And that's where we start looking at data points from a historical perspective. Again, nobody has a crystal ball and can time the market. So the next best thing is to analyze the living daylights out of past performance, market cycles, and treasury policy, and all those layers of things that provide us with hints and clues. So here we have the S&P 500. So now we're talking about just the US large company market. This is one of the things that we all refer to as the market, even though there are really lots and lots of markets. But S&P 500 is a household familiarity. So we're going to work with this one. And the point here, and what these bars are going to show us, is after a market pullback of 10% or more, what happened next? So we had a market pullback of more than 10% last year. One could look at the historic data and say, okay, well, this is what's always happened in the past. Maybe it's fair to expect this to happen in the future. So this goes back to 1926. So there's a lot of data points here. If you just start with the 1 year bar, you see the 11.3% at the top. So what that's telling us is, for every time the market fell more than 10%, all the way back to 1926, if we pulled each of those events and averaged them together, what would be the 1 year return we could expect from the S&P 500? The 1 year average is 11.3%. So remember, a market pullback of more than 10%, we're down here in fear. But if we stay the course, history tells us we'll be rewarded. So the S&P 500 returned on average 11%. So that's great. 1 year does not a long-term time horizon make. So let's look beyond that and say, okay, that's great. But what happened for the next 3 years? We're still above 10% return annualized, which means 10% per year, those 3 years after the pullback. 5 year is almost as good with over 9.5%. So the S&P 500 returned 9.6% in the 5 year period following that pullback. Let's see. So I've got some numbers here. So if we were going to compare what happened just last year with this 1 year bar here, so the average return after the pullback for 1 year was 11.3%. But we actually saw a return of 25% this time. Remember that whiplash effect, the fastest drop and one of the fastest recoveries. If you had stayed in during that time in the S&P 500, you would be up 25%. So more than double what the average is. So that just shows us what history can provide as far as being educated and providing quantitative information to help us feel comfortable. And then in this case, we performed even better than that. Ashley, do you have anything you want to add to this one?
One thing I'll say, and it was an example that came to life for me, is that when you think about these 1 year performance numbers and you actually look at what the actual performance numbers were, you're hardly going to see that 11.3%. It's going to look different. You're going to see times where it's higher, times where it's lower, and that's the market doing its job. So overall, this is the experience you have over the long haul. And in order for us to have this experience again, it just emphasizes the importance for us to stay diversified and stay in our seats through those times where you do see the numbers below and you see those jumps as well.
Great. Okay, so we've talked a lot about how we feel, about how the markets move, about what typically happens before and after a market correction. A lot of those things we can't control. We can't control a pandemic. We can't control a terrorist attack or a contentious presidential election. So what can we do? If we control everything in our ability, we'll be in pretty good shape. And that way, the other things that are beyond our control can kind of cycle through without much damage. So let's talk a little bit about what we can do. Ashley, this is something you referenced early on when we got started. So why don't you lead us off on the things that we can control?
Yes, happy to. So one of the first things that you can control is your allocation. You can control how much money you invest in stocks versus fixed income. You can control what your exposure looks like versus US, global exposure. And of course, this is something that Michelle and all of the advisors at SYM can help you with, is thinking about what that allocation needs to be in your life to meet all of the financial goals that you're trying to get in the future. So you can control that allocation, you can fit it to meet all of your goals, your needs, and your risk tolerances as well. Because depending on how you dial up certain levers is how much you're going to feel some of those bumps along the way. So that is principle number one. Michelle, anything that you'd add around that point?
Just to touch on risk tolerance, we often find, and there are some thematic gender routine to this, we often find that as females, we want to take less risk, that we have a more conservative approach to a portfolio. And I see it all the time. Typically, men want to take more risk. So we see that kind of yin and yang a lot in our conversations with people, but at the heart of it, and what you can control and try to remove the emotion from, is what risk do you need to take with your financial plan to have enough money? And are you taking enough? But more importantly, let's say you have enough. Why would you take more risk just to follow the herd? So that kind of that herd mentality that you may have heard of. So risk isn't just a factor of age, and that's how much you should have in bonds. That's a piece of it. But certainly a financial plan helps drive, and it changes over time. Life happens, we get older, and things change. So risk tolerance is really an important thing to stay engaged in.
Well, and even thinking about partnership dynamics as well. Sorry, Michelle.
No, go ahead.
Within my own house, the amount of risk that I'm willing to take versus my husband looks different as well. So there's also a dynamic of being able to manage expectations for both partners if you are navigating those things. And again, that's another place that an advisor can play that independent role in helping you determine what are your joint goals. How do we get there, and how do we both make you feel comfortable? So definitely something that I've navigated even within my own personal life, and something that I find a lot of value in through advisors.
Great. Jamie, are we having any questions come through in the chat? We good? Okay. We'll take that as a good sign, but certainly encourage everybody to chime in, make this interactive. So something else that you control is how you build the portfolio. So these are the things that Ashley was talking about when she talked about geography. You want US holdings, or do you want international holdings? What is your approach or your recommendation, Ashley, when you think of people building a portfolio, and how do they make those decisions?
Yeah, so as we said before, trying to pick a few securities, figure out when we're going to buy them, when we're going to sell them, that's not what we see works over long periods of time. There's a lot of decisions that have to be made, and overall, we see that typically it doesn't reward investors. So when thinking about a portfolio, it's holding a wide array of securities and trying to find ways to earn higher expected returns over the long term without having to pick those individual winners. So thinking about what some of those areas are, what we've seen is that there are areas of the market that over the long term tend to have a higher expected return relative to other areas. So areas such as small, value, more profitable stocks. So we can turn up those levers and have more exposure to those areas of the market so that we can try to earn that higher expected return over the long term, but we don't have to play this game. We don't have to gamble of figuring out what stocks we need to buy when to sell them, and what the next best thing is. So it allows us, again, sleep well at night, earn higher expected return, but not have to worry about what comes next or what I need to do.
And we know those things about value and about small cap and even emerging markets because we've been able to go back to 1926 and analyze what happened. So history really does play an important role there. All right, let's see. What else can we control? I have one question. Good. We have a question.
Yeah, just wondering if you could speak to the danger of not taking enough risk or holding too much in cash.
Yes, that's a fantastic question. Thank you, whoever chimed in with that. The danger of taking too much risk is risk means you could lose. You could win, you could lose. It's gambling. Are you going to bet on 15 black? Or are you going to bet on all black numbers to win at the roulette table? The problem in taking too much risk is not only could you lose it, but you don't need to take it. If you have $10 million and you think for the rest of your life to accomplish all of your retirement goals and pass inheritance along, it's going to take $8 million. Why would you invest in Tesla and GameStop and Bitcoin? You could lose it all tomorrow and be out of luck, but you also, you've got enough. So why do you want to take the risk to get more? Ashley, you have a comment on that, and then we'll talk about the cash.
What I will say is we were talking about how hard it is to take our emotions out of investing. And if we're taking on more risk than we're going on that roller coaster of emotions that we don't need to go on. So really figuring out what those goals are, how we get there, and how much is enough. If you have enough and you're able to meet your goals and sleep better at night, that's a better outcome for everyone. It allows us to not have to worry about what we're hearing in the headlines. We can kind of tune out the noise from that sense. So it's important to figure out what those goals are and how we can get there while still being able to navigate the way that we're feeling in that moment as well. So just wanted to tie it back to that roller coaster that we kind of talked about earlier.
Perfect. Now, as for the cash question, I'm glad you asked because I was going to mention at the end of the presentation if you hadn't. So I want to go back to this slide. So over time, there have been a lot of all-time highs in the market. So let's say it's 1990 again, and the market's at an all-time high. It's one of these peaks up here that's above the orange line. And the thinking was, oh, I have a lot of cash in the bank. I'm going to wait for a pullback. A, you don't know when the pullback is coming. And B, you're going to miss out on future growth. So all-time high. There have been lots of all-time highs. We're at an all-time high again. But look at the trajectory of that line. Do you want to continue to miss the future all-time highs and sit in cash? Meanwhile, even though inflation is low, we do have inflation. So cash is actually losing you money.
Yeah.
By diversifying properly and choosing the right things based on what we know from previous performance and investing in particular ways of putting some in a little bit at a time or jumping all in on a particular day, you end up still participating in the market growth and not saving yourself broke. Ashley, cash, what do you think?
I think cash has a place in a portfolio, but if you're trying to do things such as maintain your purchasing power over the long haul, that's not how you're going to get there. So again, it's about balancing what goal you're trying to accomplish. And overall, what we see is that there can be times where the market isn't outpacing inflation in the short term, but over the long term, what you see is that the market does allow you to account for inflation plus some. So it definitely is an important factor within your portfolio, is being able to maintain that purchasing power and some, if that's a goal that you're trying to go ahead and have within your own life.
Perfect. So diversify globally. There are a lot of ways to diversify. We talked about geography. A lot of times we'll see strength in the US and less performance coming out of the international geography and then vice versa. So you need some in both. For example, when we launched a US trade war, everything really heated up. US dollar was strong, the S&P was flying, the economy was expanding, but certainly international investments were lagging behind all of that because they lost one of their biggest trade partners due to the taxation conversation. That's changing back now. Now we're seeing emerging markets come on strong. We're seeing opportunities in the developed international marketplace. So global diversification is a key element to picking the right portfolio. Let's talk about expenses, turnover, and taxes. These three things can be small. They're like a drip of water. They can be small in the actual occurrence, but over the long period of time, they can really nip away at a part of the portfolio. So it's important to understand what the expenses are. Turnover is really important, and that means buying and selling a lot. There can be charges to sell or to buy, depending on who you're using. And then you're also trying to time the market, which, as we said before, doesn't work. Turnover can also result in capital gains, both short and long term, which has tax consequences. So it's really important to understand what's going on with regard to those things. Okay, Ashley, how do we stay disciplined?
You think about all of the above. It allows you to sleep at night, to not have to worry. If you're creating an allocation that fits your needs, you're setting yourself up for the best chance of success in building that portfolio around areas of the market that can earn higher expected return over the long term. You're investing in more than just the US, you're expanding your portfolio. All of those things allow you to stay disciplined because it allows you to sleep at night. You're exposed to so many different securities across the world, and you're at the end of the day meeting the goals that you need to meet. So it allows you to tune out the noise, tune out the headlines, and just focus on all of these things that you can control.
A colleague of Jamie's and mine here at SYM described it as playing with a yo-yo while walking uphill. So the uphill part would represent the equity markets, and playing with the yo-yo is that day-to-day noise, that up and down that we see if we jump in and out of the headlines at any point in time. So now that we went through kind of what we can control and where we need to be with a diversified portfolio, I want to pause for a minute and see if anybody wants to throw a question in the chat, and then we'll kind of close things up. We're coming up on 50 minutes, give or take here. We want to make sure we end on time. So I would encourage you to put any questions or comments in the chat. And then we have a couple of things that we can wrap up with. One of the things that has been a hot question lately, and I'm sure for you too, Ashley, is what about inflation? That's been a big headline lately. We're finding that our Treasury Secretary just yesterday, Janet Yellen, is making some public statements about what she thinks is going to happen. The Fed, who controls the interest rate, their actions indicate what they think is going to happen. Meanwhile, there's still the market movement based on what the predictions are. So, Ashley, what do we really see with inflation coming up?
Well, that's the primary reason why I invest in the market in the first place, is in order to protect myself against things like inflation, to maintain my purchasing power over the long term. Again, there can be periods of time where the market doesn't keep up with inflation over the short term. But again, we're talking about staying disciplined, staying invested over the long term. And what you see is that over the long term, the market outpaces inflation. So it really allows us to sleep well at night, know that our dollars are going to be there when we need them. And if you think about the reasons why you are investing, why you are creating this asset allocation, that's one of the things that you're protecting against. And that's one of the reasons why I am actually invested in the market in the first place.
Absolutely, and ditto to everything Ashley said. In fact, we have currently a slide in a presentation that we use regularly that shows where to invest, what's historically the best place to be in an environment of rising inflation, and equities provide the right equities provide an excellent opportunity. So again, that diversified portfolio and participation in the equity markets. You have a question, Jamie?
I do. With interest rates and bond yields so low, how are you approaching the fixed income allocation of a portfolio?
Oh, great question. Typically, in a well-diversified portfolio that is appropriate for the individuals investing, you would have a combination of equities and fixed income. Ashley mentioned that as part of the diversification in the early part of today's talk. So you've got some protected over here in fixed income. The rest of it is earning or growing faster, more volatilely in equities. Even in times of bond performance being low or even negative, like it is just right now, rising rate environments, et cetera, you still see less swing in the fixed income investments. The equity investments are more volatile. You also want to hang on because you want that diversification in bonds. Might not be performing really well right now, but I'll tell you what, they did great last year and they will again in the future. So it's part of that whole going back to buy it low, sell it high, be well diversified for the long haul. Ashley, do you want to chime in on that one? It's a great question.
I think this is a great way that advisors add value when thinking about asset allocation, is thinking about, again, going back to the example of, if you need $8 million to meet your goals and you have 10, why are you taking on additional risk within your portfolio? And fixed income is a way that you can soften some of those spikes that you see within the chart. So again, another way that you can think about what your goals are, how you get to those goals, and where you and the advisors at SYM really play a key role in figuring out what that ideal mix and balance is.
One of the things that we do in our fixed income portfolio, just like we keep saying, is diversification. There are different kinds of bonds. So you've got government bonds and corporate bonds, which are very different from each other, both in a fixed income portfolio. So that's another way, another layer of diversification to find long-term benefit. You have any other questions, Jamie?
No, that's it.
Okay, I have two unrelated questions, but that came through and they're excellent. And really that's the theme of why this group gets together, is to throw things out there and see what the common answer is or understanding is, if anybody else has the same question. And the first one is about HSA accounts. So in some cases, folks have an HSA account that has a growing balance. In other words, they're not pulling out the money every year to pay for medical expenses, and they're able to grow that balance to use it in the future. In many cases, those all start out in a checking account or a savings account situation. But once they get to a certain size, you have the ability, in many cases, not all, you have the ability to invest those funds. And that is absolutely something that's worthwhile. Ashley, can you give us a quick high-level Super Roth explanation?
Yes, I can actually give you an example of my own personal financial situation. So I have an HSA that's offered through my employer. They put some money in, I put in the rest to max out that amount every year. And I have that invested in a global portfolio of stocks. And the reason why I do that is because there are so many benefits for me in the long term that I see. Once I turn 65, I'm able to use that money on things that are not related to healthcare expenses. So again, another way that I can save for my retirement, but should I use that money towards healthcare costs, I also get a tax break as well. So for me, instead of investing in long-term care insurance at this point in my life, I'm using that as a way to fund some of those costs. Again, as we said before, we women tend to live longer and as a result often face higher healthcare costs. So that's one way that I'm securing my future, is by funding my HSA, investing it over the long term, and I pay for all of my medical expenses out of pocket at this point. Should I need to use that money, of course it's there and I do have the ability to use it, but just another way that I'm able to save for my retirement or save for any unexpected healthcare costs in the future as well.
So highly recommended. It's not always available, but often it is an option. So check with your bank, your HSA provider, your HR department, or your financial advisor and see what works for you. The second question I just love, because I wasn't familiar with this option, but I do have young adult children, and it's really difficult these days, I think, for young people, especially, to understand debit cards, credit cards, budgeting, paying bills, all those things, because they never touch money anymore. You don't even get a paper paycheck most of the time. So it's all this smoke, virtual stuff, and it's really tricky to navigate. Ashley, what was your learning experience when it came to household money management?
I would say I was very fortunate that I did have a family that, as I got older, was comfortable sharing information with me, trying to teach me about personal finance. I think I said something that scared my mom and my dad when I was a child. I don't remember what it was, but it sparked a conversation where my dad was like, okay, I'm going to teach you how to balance a checkbook. I'm going to help you open up your first accounts. And we're going to run through this entire example. So he actually pulled out all of his pay stubs. He was part of the labor union. They did a great job of itemizing where all of that money went, where you see portions going to his pension, where you see portions going to other retirement vehicles. We lived in New York, so we saw the local the state tax and the federal taxes coming out of paychecks as well. And I learned about taxes while I was in high school because I was gearing up to get my first job, and my dad wanted to explain how I had to save for these things because I was a 1099 employee. So overall, I was very fortunate in having that hands-on experience with my father, and it really helped set me up for success in the future. And it was a lot more tangible. We got mailed the checks. I saw my passbook where we went to the bank, they would stamp the physical passbook and you'd see that grow over time. But now that we live in this digital world, a lot of those things are very different. It's not as tangible. But what I will say is if you have those opportunities to share those moments with your children, give them a glimpse into what your financial situation looks like, how you think about these things, and start to impart some of that wisdom, it's going to go a long way in setting them up for success as well in their future and learning about money.
And a resource that came across our radar, thanks to Carol, is this Greenlight. This is a screenshot from Greenlight's website, and it does try to replace what used to be tangible for young people with debit cards and early principles of financial planning. I would urge you, if there are young people in your lives or in your circles, to maybe check this out. It seems like a great way to try to teach those principles that were easy before when we had paper checkbooks. Online banking makes that whole thing obsolete. So I would highly recommend considering this or something like it. Okay, we're gliding in right on just shy of an hour, so I'll go ahead and wrap it up. Ashley, I can't thank you enough for participating from Austin, Texas. Adding your insight and your stories is truly appreciated. And I want to thank everybody else who took their lunchtime to join us today and to chime in and to chat. Ashley and I will stay in the Zoom room for a little bit. So if somebody has an individual question or a specific situation they want to ask about, you are welcome to do that. I would also say that we are planning a fall Join the Conversation in person, fingers crossed, that will also be live streamed. So watch for more information on a fall session.